Below here, sell stops. Okay, so that's what we call sell side liquidity. So the market taps into that here, and then once more here, and right there, we're getting divergence between the lows of the NASDAQ, and I'll show you what that looks like with the candlestick real quick. See how we went lower here? This low, this low, this low, respectively. On the NASDAQ, it's higher each, okay? So it didn't make a lower low on this pass on NASDAQ, which is the lower chart I'm pointing to, at the same time that the S&P went lower. But that divergence there was enough for me to look at this liquidity as a raid, especially if we run a short-term high, which is what we get, that short-term high right there. It runs through it there. Once it runs through it, all right, this short-term high right there, we run through it there, that candle. So we have technically a shift in market structure that's bullish. Now, a shift in market structure, this is for your notes. Market structure shift is just a short-term change in market sentiment, and it will deliver on a short-term basis. A market structure break is where the entire tide of the marketplace changes, and we go into a longer, higher time frame delivery of price, where if it's been bullish, and then we have a break in market structure that's bearish, then what we're saying is there's a change in trend. A shift in market structure is not equivalent to an outright reversal. It's just a change in short-term market sentiment. And that's all we need to capitalize on in terms of intraday price action. So when we see the short-term high changing here, right there, that candle, once it passes through it, for your notes also, a shift in market structure does not require a higher close above the short-term high. It just needs to trade above it. The algorithm is not basing its next run on price because it closes above that. It just needs to run through it. Once it does that, that trigger now starts a macro. A macro is a short list of instructions that the algorithm will run, and the price engine that creates these fluctuations in price. It matters not how much buying and selling pressure. That's a misnomer. It's a lie. Okay, that is not how these markets book. I don't care who tells you otherwise. Okay, it's not the volume. So once we get below the sell side here, we run through this short-term high. There's a shift in market structure. Now it's bullish. So your eye goes to what? My eye goes to where's liquidity. So the first thing I want to look for as I pan back is I want to look for, is there a relative equal high, something smooth? Well, these highs are basically almost the same, right? When the market trades down to the sell side here, and then I'm watching, does it shift bullishly? There's a shift in market structure with that candle right there. It does not need to close above it. So now in my mind, I go back through what just took place. Well, we just ran sell side. We have SMT divergence, not using an indicator, just comparing correlated markets. The Dow, the NASDAQ, and the S&P. I'm comparing the price action between those three instruments. If I'm anticipating the likelihood of something bullish, I'm already expecting the SMT. I'm not using the divergence as a trade selection. It's a confirmation tool. It qualifies something that I had already anticipated. This was too smooth. We were going below sell side. We went through it. If we went through it and we didn't diverge, and if the NASDAQ made lower lows with the S&P, then I would not expect this. So now some of you are probably thinking, can you just tell me what you were trusting and what you wouldn't have trusted? I just told you. If the NASDAQ would have made a lower low like it did here in the S&P, I would not have gone long, even if it went above that short-term high here, because then I would have expected this fair value gap to be something to be monitoring. But because we had that divergence with the NASDAQ lows not meeting the lower low that we see in the S&P here, then I want to watch and see, does it show its hand to me? Does it tip its hand to me and say, Michael, this is what I'm about to do. I'm going higher. Get on board. I'm going to give you a fair value gap. It runs above the short-term high here, there, and as it's coded, just like it's supposed to, this candle's high and this candle's low. That's what I'm framing here. That's the fair value gap. Now it drops down. What time is this? 9:45. That's when I told you the news was coming out. Now, that news report, I'm not afraid of that kind of report. It's not the same thing like a CPI. CPI will rip your face off. Like you do not ever want to be trading ahead of the CPI number. Ever. You don't ever want to be trading ahead of a rate announcement. Ever. Because it will tear your limbs off. You don't want to do that. But other market reports, they will just be fuel. to something you already anticipate and see. So this 945 candle, notice it does wick through the fair value gap, but does it take out the low? No. Your stop could originate here at that low, buying this candle's low. That's your first entry. You can use that. You can use the consequent encroachment, which is the midpoint of the gap, which is this one candle. So when I'm talking about things on Twitter, I'll say ES 1 minute chart, and then I'll give a 09:42. I'm not saying I did it for this one here, but the other ones I'm going to refer to, I did. If I'm telling you 09:42 and I'm telling you 1 minute ES, I'm telling you to look at the ES chart, find that time on the axis at the bottom of the chart, and put it right on that candle, and you'll see exactly what I'm looking at. So the market dips back down into this area here on the news, comes back up, and the candle closes here. The next candle opens, trades one more time. What's it trading into? The fair value gap one more time. This is the only other opportunity you have. If you're going to be using that fair value gap, you got to buy it, smack it right as it goes into that candle's low right there. It goes a little bit past it, but not much. But what is it really reaching for? Look at this wick from the low of the body, which is the closing price, to that low. Eyeball half of it. Boom. And it's also inside the fair value gap. Then it rips through this short-term high. This is a bullish breaker. What is that? The low here makes the high, and then a lower low. So this move up, you were focusing on the highest up close candle. Extend that range out. So as it's digging into this here, this is a return into that bullish breaker. Here's how you classify retail support resistance as the real levels to be trusting, okay? If that high has a low prior to it and a lower low after it, after this high forms, then it comes back down to it, then yes, you can trust it as resistance broken turn support. The narrative behind why it should be that way is what makes my breaker the breaker. It broke anyone that was holding stops below here. It went lower than that and then ripped through this short-term high. This in itself is a shift in market structure. Same event is occurring with this short-term high here when that candle passes through it, is occurring with this high, with this movement right there. The logic is that we've done damage with this candle being a high here. It took out and broke. It broke the backs of anyone trying to go long on that low. When it ripped up higher like this, then it went down one more time to knock them out. There's liquidity taken here and absorbed. What kind? Sell side. Who would want to take out sell side? Individuals that want to go long. Smart money, buying those sell stops up. They're being counterparty to it. And then using the fair value gap as it drops into here, and then one more time here, and it rips through this short-term high here, and it comes right back down into that high. But more specifically, it's a bullish breaker and old high, yes, and there's a fair value gap right there. You have three things qualifying that level. Over here, this low here, take a look at the hourly chart here. The Monday 23rd of January's hourly candle. Note that that's a fair value gap. Okay, that rectangle is the same rectangle that's being shown over here. So it's going down to that level based on the hourly chart. It trades down to it here. It trades down to it here. That reaction is what I tweeted. I said, note that when we were inside the fair value gap here. I taught last night that you can look for inversion levels. If you extend the fair value gap in time, look where the bodies are collected inside the fair value gap. It trades right back up to this candle's low, does it here, hits it, hits it, hits it, hits it, breaks lower. There's 5 handles there. So 10 handles offered without really expecting a lot in terms of risk. There's risk every time you take a trade, obviously, but in terms of movement against the idea that once I tweeted it, very little fluctuation or what would be considered drawdown. The market then rallies, returns back up into the area of what? It returns back to this pool of liquidity there. Then it comes right back down into this right here. Take this off. This candle here and this candle here is one order block. An order block has nothing to do with the depth of market or level 2 data. It has nothing to do with actual orders. When I say it's an order block, what I'm saying to you is the algorithm refers back to this as an order block. It has nothing to do with mitigating. Order blocks don't get mitigated, okay? The market, when it trades back to this level here, you want to take the opening price, extend it out in time. All right, so this order block, okay, this run lower and then shift in market structure, where's that occur? Right there. That candle right there. It's a shift in market structure. What took place? The sell stops or sell side liquidity resting below here has been purged. So if we take this level here, put it right there. I told you when we were here to put that level, the blue shaded area on your hourly chart, and denote that. If it was up here and I tell you down here, where's my bias? Down. How far? To that fair value gap. But this down close, these two down close candles, that's an order block. The algorithm, what's doing is once this shift in market structure occurs here, like it does right there on that candle, right at that moment there, the algorithm says, okay, I need to reprice higher. It's going to start booking price higher. This return to this order block, the market will want to do that. Once it does that, it accumulates buying opportunities. Let me say it better. It provides smart money to accumulate long positions when it returns to this. The algorithm is not waiting for smart traders to buy, and their buying is not propelling price higher. It's going down there based on time. It goes down to it here, pulls away from it, and goes down to it one more time. It's spending time allowing individuals that are privy to what I'm teaching you, what I'm showing you. There are people that are waiting for this opportunity. That is what they're paid to do. But this run here, did it take out that high? On this run here, away from the order block, when it has a shift in market structure on that candle right there, when it moved up, did it take out that high? No. What did it leave there? Buy side. The market drops back down into the order block. The algorithm offers the opportunity for traders that are looking for it to get in. Reprices higher, rejection block, retraces back down to the order block. Once more, what's it doing? It's allowing smart money to accumulate inside the order block. What else is it doing? For supply and demand, folks, fasten your seatbelts. We're cutting through some candles. Oh no, we're going back into that area of inefficiency. It was inefficient in what? Sell side. It went up. It offered it here. Okay. Is this balanced? This range here, is this range here balanced at that point? No. It's only balanced when it comes to it and leaves it. Now it's a balanced price range. This is an entirely different endeavor of running out liquidity that's formed here. It does not cancel this out. If you've gone through my core content, I teach you the PD array matrix, and there is a 20, 40, and 60-day look back. And there's a 20 and 40, 60-day cast forward. The algorithm refers to things in that scope. For the folks that's been here for a while, this is already starting to make a lot of sense to you, and your gears are turning like, oh my goodness, I see it. Right. It's going to keep repeating too, every week, every day, and it won't stop. So it trades down into the old fair value gap. What is it offering? Sell side again, here, and the order block. So how many factors do you have here leading to the likelihood of these relative equal highs, much like they were over here? What's above here? We have buy side. What did price do from here? Drop down to what? To that low. Why did it do that? It took out sell side. Why would it be advantageous for the algorithm to reprice all the way down there? You're trying to tell me that only short sellers came in here. Nobody bought. And that's what drove price down exactly to the fair value gap that I outlined beforehand. So every trader out there knew the fair value gap. You all just discovered it this year. I've been using it for 26 years. The volume of how many contracts are traded is irrelevant. When they want the market to go to a price level, it's going to that price level regardless of how many buyers and sellers there are. Why would it be advantageous for this level to be taken out? because it's allowing traders that would be looking for higher prices, keying off of that discount array, which is the fair value gap on the hourly chart, that blue shaded area down here. But this movement here was the catalyst that sent us up into the buy side liquidity that I talked about in this live stream. That's where it's going to go next. What does that mean? It's not going below that low. Your focus was placed up here. But then we run from the order block up to and through that buy side liquidity. Runs above it, comes back down, works inside this range here. What's this down close candle? What's this right here? It's the same thing this is. It's an order block. It has absolutely nothing to do with how many contracts are bought or sold, but this is an order block. Okay, it's a down close candle prior to the change in the state of delivery, which is occurring right at that opening price. Extend that out in time. As soon as that price is touched and crossed to the upside, that is equivalent to a market structure shift. At that moment, this entire range here becomes sensitive to future returns to it. So down close candle, displacement to the to the upside. Watch that opening price. Why is the opening price? Well, because there's no wick. Well, why did you use the opening price down here, ICT? Didn't think I'd get back to that, did you? Why don't you do it on the wick? Because whenever there's a short little stubby wick like that, I just immediately go right to the opening price. That's just because I've traded Forex, and Forex has a lot of spread issues, and that was where I adopted the rule set. There it is. But the hard and fast rule is if it's a really small little wick, just go to the body's opening. Market trades down into it here. Look how much around the midpoint of that candle, which was mean threshold. Half of a gap or inefficiency is consequent encroachment. It's the midpoint. If we have a order block, that's not a gap. That's not a fair value gap. It's a specific range in one candle. You split that in half, that's mean threshold. Look where they're going right here with these candles. Boom, half, 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 half. And then breaks higher.